Welcome to the Same Day Podcast, where we discuss driving incremental business growth and other topics related to real estate, property management, and entrepreneurship. Now, to the show at hand.
Hello, Yoni Schmidt here, hosting today's episode of the Same Day Podcast, where I connect with top business and real estate leaders. Past guests include Kurt Volk, a client investor and now a real estate agent in our office, Jared Goldfarb, Vice President of Bank First, and Brad and Megan Skaggs, the owners and operators of The Beauty of Wealth. Today's episode is brought to you by Keyrenter Property Management. At Keyrenter Property Management, we are a full-service property management company helping our clients buy, renovate, and operate real estate assets. We help our clients build wealth while taking the headache out of property management. That's why no matter what rental you have, single-family homes, condos, townhomes, apartments, we have the management solutions you need. Go to KeyrenterPMC.com or email us at info@keyrenter.com. Welcome to our podcast, where today we're thrilled to have Marissa LoCascio, the Senior Vice President and Chief Compliance Officer at 1031 CORP. Marissa is joining us today. She's a distinguished expert in the field of real estate investments, specializing in 1031 exchanges, a vital tool that allows investors to defer capital gains taxes. With a career spanning over 2 decades at 1031 Corp, which is extremely impressive, Marissa has facilitated thousands of successful exchanges, demonstrating her unmatched expertise and dedication to making the complex process of 1031 exchanges simple and worry-free for her clients. Her commitment to education, combined with her certifications and deep understanding of real estate law, make Marissa a sought-after speaker and a revered figure in the real estate community. Today, she's here to share her invaluable insights on 1031 exchanges and how investors can leverage this strategy to achieve their investment goals. Join us as we delve into the intricacies of 1031 exchanges with Marissa LoCascio, a true leader and innovator in the world of real estate investments. Welcome to the show, and thank you for being here, Marissa.
Thank you for having me. Great to be here.
Yeah, so I'm really curious about this topic, and I've been, very excited to, have this record this podcast with you today, mainly because I am interested in doing a 1031 exchange, and I am also working with a client who wants to exchange a duplex into a piece of land that he's wishing to also develop. So let's dive right in, and
Sure.
we can hopefully bring some good content to our audience here. Marissa, could you start by explaining what is a 1031 exchange and why is it such a valuable tool for real estate investors?
Sure. So, kind of basic, what is a 1031? It will allow real estate investors, right? As long as you're owning real property that's been held for business use or investment, you can sell that, do the 1031 exchange, and defer the taxes that you normally would have paid, as long as you're buying another piece of real property that's going to be held for business use or investment. So it really does allow real estate investors to kind of build up their real estate portfolio and use those pre-tax dollars in their pocket working for them, rather than shuffling it off to the government, right? And they do whatever they're going to do with it, right? So it really kind of gives them the ability to accomplish short-term and long-term investment objectives. Maybe the sale of that duplex, maybe that's their first 1031 exchange, and what they buy is something that, yes, is going to defer the taxes, they reinvest, and it gets them, closer to potentially what their eventual goal is, which maybe down the line is buying a large commercial piece of real estate. But the first 1031 doesn't quite get them there. They need to do a couple to get there, right? So they can really utilize 1031 to get them where they eventually would like to be.
Mm-hmm. Yeah, that's interesting. So the money they've already, spent to purchase the initial property, which is what's known in the world of 1031 exchanges as the relinquished property, right?
Yes.
That was purchased with money that they've already earned and they paid taxes on. So if they go sell it now, they have to pay any capital gain taxes, short or long term.
Right.
depending on the timing of the sale. But in order to defer that capital gain tax, they can just exchange it into a like-kind asset. You mentioned a few things, and I want to touch on those. But with your experience at 1031 Corp, what common misconceptions do investors typically have about 1031 exchanges? One of them could be, can I 1031 exchange my primary residence, for example, into an investment property or into 5 investment properties? Is that something that you can do?
Right. So that is a question we get a lot. And as great as 1031 is, there actually is a way better section of the tax code for your primary residence. So you cannot 1031 exchange the house that you live in, your primary residence, right? But if you have lived in that primary residence for 2 of the last 5 years, you get to use section 121 of the tax code, which says that if you are an individual, you can exclude up to $250,000 from that sale. And if you're a married couple filing jointly, you get up to $500,000. So that requirement does not have any, you have to reinvest piece to it, which 1031 does. So 1031 doesn't work for your primary residence, but you don't want to do a 1031 on your primary residence anyway, right? You get that way better section of the tax code to utilize. So that is a big question that we get a lot. One of the other big misconceptions, there's actually kind of 2 with 1031. You would use the word like kind to describe the type of asset that you can reinvest into. And that is a little misleading. A lot of people think that if they are selling, let's just say that duplex, right, that they have to buy specifically another duplex. And that's not true. The requirement is just that it be real estate and you hold it for business use or investment. So you can mix and match residential and commercial. It can be any type of asset. It does not matter the very specific type of real estate. So it's a really broad definition, but there is a lot of misconception out there. And the other big misconception is how much you actually need to reinvest when you're doing the 1031 to really maximize your tax savings. And a lot of people think that it's either just the amount of the gain from their sale or that it's just the amount of cash that they get out of their sale. And neither of those are accurate, unfortunately. So when you do the 1031 exchange, ideally, what you would try to reinvest is equal or greater value and equity to the property that you've sold. So let's just use real numbers, right? You sold for $500,000. They do allow you to subtract off closing costs. So things like real estate commission, transfer taxes, items like that. Let's just say your closing costs in this scenario were $50,000. So now you want to look to buy something for approximately $450,000 or more to really maximize your tax savings. You also need to make sure all the cash you get from the sale gets reinvested. And if you did pay off a mortgage, whatever value of that mortgage payoff, that also gets reinvested. So you buy a new property, right, for $450,000, and let's say you had $200,000 of cash, you paid off a $250,000 mortgage. Both of those values need to be reinvested into that new property to really maximize your tax savings.
Yeah. So you have to replicate at least the amount of debt that you had on the property at the sale, if not more.
Correct. Yep. You can always buy for more. That's absolutely fine. Where it starts to get a little tricky is if you do buy for less. So, let's just say you didn't quite make it to that 450,000. So you only bought for 400,000. Wouldn't make the whole thing taxable, right? It would just simply be that very small trade down or the 50,000 that didn't get reinvested. That would be taxable.
So in that instance, would that be a partial exchange or essentially?
Correct.
Yeah. And so you're paying the capital gains on the difference of whatever was not invested.
Exactly.
And how often do you see that people just go out and they look for another property to invest in? And so now they're exchanging, say, one duplex for two duplexes or one house for two or three houses. Is that something that happens often? What's the process there? What are the rules if you're identifying three or more properties? Can you walk us through those a little bit?
Sure. Yes. And it does actually happen quite often that people are reinvesting into multiple properties. So, maybe they sold one and it was a higher dollar value property that they sold, and they would like to buy two or three properties
Hmm.
and, split up their equity that they've got over those three properties, which is perfectly fine. Um, and that actually became more of a trend in the last couple of years, I would say, people acquiring more properties through their 1031. It used to be a little more plain vanilla. They sold one, they bought one, and now it's kind of, they're diversifying, they're getting multiple properties, which is great. And the identification rules, you technically can buy and sell multiple in the exchange. So even if you sold multiple, you could do the opposite of what we just talked about and buy one large property, combining all of those sales. That absolutely works too. But
Hmm.
with the 1031, there are, yes, identification rules, and that 45-day identification time deadline.
Hmm.
That will start the day you go to closing on the property that you currently own. So, that settlement date, you give up legal title, that triggers a 45-day identification period. And within the 45 days, you have to identify what you would like to acquire through the exchange. And of course, there are some rules. They don't let you just list, a property on the MLS. That's not going to work. So it has to be, you can follow what they call the three property rule, which
Hmm.
is what most will go with, to be perfectly honest. You can identify up to three regardless of their combined value. If you decide you would like to identify more than three properties, you can, as long as, when you list all four or more of those properties, when you add those together, the combined value can't exceed twice what you sold for, or 200%. So if we go back to that, that example of the $500,000 property that you sold for, let's say you wanted to identify four properties. You can do that as long as when you add up all four, they don't total more than $1 million.
Hmm.
So, not a ton of people will use that 200% rule. Usually those that are selling for pretty high dollar value will utilize those. They sold for 13 million. So now they've got 26 million to work with as a 200%, and that could work for them. Right. So
Yeah.
it does kind of limit you, but you can acquire more than that if you wanted to, right? So let's just say you knew that you wanted to buy 7 different properties, and let's say it was being sold as a package deal from a seller. You could buy all 7 of those because now you've acquired everything that you identified, which is an acceptable exception
Hmm.
under the identification rules.
Yeah. So if you're exchanging that same duplex, say for example, for 10 properties, and each of them is say roughly, $100,000, so that it
Okay.
doesn't exceed that limit. Um, Tell me, do you have to close on a certain percentage of that portfolio that you identified, or is that a misconception?
So if you sold and you identified 10, was that the example that you gave? Okay.
Mhm.
So in that example, you obviously went over 3 properties, right?
Mhm.
It depends. Are you still within the 200% with your 10 properties?
Let's assume yes.
Let's assume yes. Okay. Then you technically don't have to buy everything on that list as long as you're still within that 200%. Where it starts to get into you must buy everything on that list is if you've broken both the 3 property rule and the 200% rule.
Mhm.
So if those 10 properties are way over the 200% value, you are then subject to what they call the 95% rule, which basically means you must buy everything on your list.
Right.
95% or more on your list. So that's where it starts to get a little tricky.
Very interesting. Okay. Can you walk us, I guess, through the process of a typical 1031 exchange from start to finish and,
Sure.
a nutshell, let's say? I know
Sure.
that,
Yeah.
it starts with you basically deciding that you want to sell one of your existing investment properties.
Right. Yep. Yeah. So typically, right, you're going to list that for sale. And when you find a buyer, you get that under agreement. Most times, that's when people will call us to initiate the 1031 exchange once they have a signed agreement with their buyer for their current property. So once that happens, they fill out our order form, give us a copy of that signed agreement of sale, and also the closing details, right? Because we need to coordinate with whoever is handling settlement for that particular property. We will prepare the necessary paperwork, coordinate with the closing agent. Once that property closes, that triggers the 2 time deadlines. The first is that 45-day identification period, right? There is also a second time deadline that gets triggered by that same closing of the relinquished property, your current property. And that is a total of a 180-day exchange period to acquire something on that 45-day list and get the 1031 wrapped up. Once closing has happened for the property you currently own, right? Those are triggered from the sale. The proceeds, they actually cannot go directly to the seller. That's one of IRS's rules. So those funds would be wire transferred to an account that we set up for that seller with their name and tax ID attached to it. It is an interest-bearing, segregated, FDIC insured account. Okay, and within the 45 days, they identify something to us or multiple properties, maybe one of which they're really trying to go after and have the 2 others as backups. Once they know what they are going to acquire, they get that property under agreement. You can use the 1031 funds for deposits. So if they need that money to, be sent to a seller for a deposit, we can certainly do that. We just need a little bit of paperwork in place. We coordinate with the closing agent on that purchase side, right, to make sure they know that it's part of a 1031 exchange. We wire transfer whatever funds we have in that account that we set up for the seller. We wire transfer those funds to closing. The acquisition occurs and their exchange is finished.
Beautiful.
Sounds easy when you wrap it up like that, right?
Sounds,
Probably a little harder in real life.
Yeah. So you're essentially the financial intermediary who's acting as, a fiduciary holder of those funds. And you're saying that you can pay out, for example, earnest money to the title company or to the broker who's selling you another property, right? Can you pay for inspections and appraisal and survey, and what other fees are you allowed to, use the proceeds for? Could you use some of them even for closing costs and to buy down some points on your new note? Tell us a little bit about it.
Right. So typically any cost associated with obtaining a mortgage does not work. You cannot use the 1031 funds to pay for those items. So the appraisal points, things like that, no. An inspection would, as long as your contract is contingent upon it, which most are, that would be something that we could release funds for. So they would just, provide us an invoice and we could pay that vendor directly, or that contractor or inspector rather.
Got it. Beautiful. What about any work that, needs to be done on the property prior to closing? Say, for example, I'm buying a house and it needs a new roof. And, I want to put that new roof on there before I close. Is that something that 1031 exchange proceeds could be used for?
Is this on the one that you're selling or the one that you are buying?
Not the relinquished, but the acquired.
The acquired property. Arguably, it could, but you would want to make sure that you're working with your real estate professional to make sure you don't get burned in that instance, right? Because you're going to make some sort of improvement to a property that you don't own just yet. So, usually what we have seen in the past is perhaps that invoice being paid at closing, and it's a line item directly on the settlement sheet that gets paid to whoever that contractor is. And that way, there's no chance of the seller backing out of that deal and taking your 1031 money to fix their roof and then going, I don't want to buy this property or sell this property anymore.
Right, which would put them in a world of trouble, and I bet
for sure
end up in a lawsuit for specific performance that the buyer
right
would ultimately, but it doesn't necessarily preclude them from then having to pay the capital gains tax because it's a prolonged process. So a couple things you mentioned. One is, you mentioned timelines. One is a 45-day identification period, and another is a 180-day closing period, right? So you have to identify from the day that you close on your relinquished property, the one that you are selling. You have to identify within those 45 days, right, the properties, at least 3, right, that you're going to buy. Is that true?
Yes, you don't have to do 3. I mean, if you know for sure,
if you could go for that.
The one. Yeah.
And then the 180 days, do those include the 45 days, or do those start after the 45 days end?
The 45 and the 180 do run concurrently. So it's 45 and then the remaining 135 to get it all wrapped up. Correct.
Got it. Beautiful. Tell me what happens, I guess, in the event that you're doing an exchange later in the year in November, for example, because that would put you into the next following calendar year. What are the rules there? How does it deviate or change? Are there any, is there any new regulation that's been introduced, for exchanges that close towards or that are initiated towards the end of the year and then roll over into the following year? And what are the tax implications for an owner or a seller, an investor who is doing that November, December, and then, they're rolling that into the following fiscal year?
Sure. So the 1031 exchange does have to be reported in the tax year in which it was initiated. So if they closed in November or December, let's just say it was of last year, right? So 2023, that 2023 tax return is where your 1031 exchange would need to be reported. We have some taxpayers currently that are not done their 1031 exchange, and we're creeping up on tax time, right? So what would happen is they would need to file for an extension of time. If they were to file their taxes, their 2023 taxes, they effectively would end their 180-day exchange period. So, we make sure that they know, it's in our materials and all over our website, of course, but just make sure that they know, hey, don't file your taxes just yet if you're not finished with your 1031 exchange. So we want to make sure they get the full benefit of that 180-day period. The other thing that I'll mention, let's just say somebody did start their 1031 exchange back in November, December, whatever it may have been, and they, for some reason, couldn't nail down what they wanted to identify. If they initiated their exchange, right, in the previous tax year, 2023, but they didn't actually identify and then subsequently received their proceeds after day 45 had expired, but now we're in 2024, which is another tax year, they actually are spanning 2 tax years and could potentially have a little bit of a benefit there. Obviously, they're not completing the 1031, so they don't get the full tax deferral, but they could, in essence, break up their tax consequences and report some in 2023 And then because they didn't actually receive the funds until the next tax year, they could report some tax consequences in 2024. So, you know, it is, yeah, a little bit of an unusual time when you do span over those 2 tax years.
Yeah, I guess the break would depend on, you know, your tax bracket for each of those years and your income situation for each of those years, and
Right.
you know, you'd have to look at it on a case by case basis. Very interesting.
Sure. Their accountant would help them determine like what would work best in our situation here. Yeah.
I mean, that's why it's so important to just, you know, use a reliable CPA who really knows the tax, you know, implications, understands the business that you're in and the industry that you're in, understands real estate, and someone who can, I guess, work with you, with the title company, with, you know, you at 1031 Corp to, you know, maximize the individual's income and minimize their tax liability at the end of the year.
Absolutely.
Because that's what I guess you exist for, right? To minimize tax liability.
Right. I mean, we obviously want to make sure that those that work with us are getting the most out of their 1031 exchange, but as the qualified intermediary, we are prohibited from giving tax or legal advice. That's the reason we're qualified, because we don't provide any other service for them except facilitating 1031 exchanges. So it really is invaluable for someone to have good advisors that they work with that can help, you know, in their particular tax situation, figure out what's going to be best for them.
Yeah. Wonderful. Beautiful. You mentioned earlier, though, that I can't go on to the MLS and just find a property and, you know, say, this is the one, I'm going to buy it. Can you tell us a little bit about that, and why is that the case? Because I wasn't familiar with
No, what I meant by that was that you can't just say that your identification is going to be a property on the MLS. It's not specific enough. So if you have access to the MLS, right, then you can absolutely go on there, figure out which 1, 2, or 3 you want, and then write that very specific property on the identification list, but it can't be vague. It has to be specific. That's the difference there.
Got it. So you can say 123 Main Street is the one that I'm identifying, and it's in the MLS, and technically I'm you know, going after this one. Got it.
Yeah.
Tell me, I guess, you've been instrumental in educating real estate professionals and investors about the benefit of, you know, the IRS Section 1031. Is it IRS or IRC? I guess it's IRC because it's
yes. Yeah.
You know, aside for what we, you know, have discussed so far, what key points do you always try to highlight in, you know, your presentation, seminars, conversations? You know, what's something that, you know, an investor should always be on the lookout for?
Right. So we've talked about 2 of the really big rules, you know, how much you need to reinvest, right? That's a big factor. We have also talked about the time deadlines. Those are really big. There's also one last kind of big rule that we always share with everyone to make sure that they know, and it's called the same taxpayer requirement. Essentially, however you currently hold title to the property that's being sold in the exchange, that's how you need to buy, right? So individual to individual, LLC to that same LLC, so on and so forth. And that can be a little tricky because sometimes people own properties in different ways, or perhaps they own it in an LLC and not everybody wants to exchange. And that can get a little complicated to do if not everyone wants to do the exact same thing in 1031. So that can cause a little bit of an issue. But generally, you want to make sure same taxpayer on both sides of the transaction.
So that brings me to my next question, because I own real estate on my own. I own real estate in partnerships. Say, for example, you know, one of my business partners and myself want to go sell a portion of our portfolio, a property and I say, I want to do an exchange. My business partner says, I'm not interested in doing an exchange.
Mhm.
Is that even possible? Because now you're saying, right, the tax EIN, the employer identification number, that's on the exchange, right,
Mhm.
will not be
Yeah.
the same as the one that is selling it.
Right. So if you own it in an LLC, right,
Yeah.
with, another person, it's a multi-member LLC, that tax ID is what IRS has been seeing, as far as income, depreciation, expenses, that sort of thing, right? So that's the history that IRS has. So if you were to go and report an exchange where all of a sudden it's just your social security number and you say you're doing a 1031 exchange, IRS is going to be confused. Those two things don't match up, right? So therein kind of lies the issue and a potential red flag.
Mhm.
So if you're planning ahead, you certainly could, make sure that you are doing the necessary steps to change that history with IRS, which means you need to kind of start getting things in motion well ahead of when you would actually sell the property and have
Mhm.
something to report to IRS. So what we've seen in the past is what's referred to as a drop-in swap, but with ample time ahead of the what they call drop. So you would basically take it out of the LLC, you would liquidate the assets, put everything into individual names, and everything that reflected the LLC, that same scenario would have to be true. So utilities, insurance, bank accounts, right? It's no small task, that is for sure. And then you
Mhm.
would file a final tax return for that LLC and start reporting it as two individuals, right? Tenants in common with each other, each taking your portion of ownership on your individual tax returns, so on and so forth. And that would be, ideally a tax return or two, and then sell the property. But that is a lot of planning, right? And
Mhm.
that sometimes doesn't always work
Yeah.
because people call us and they've already got the property on the market. They have a buyer, and closing is in 3 weeks. So
Yeah.
that scenario doesn't always end up working out for folks.
Yeah. And so then one partner wants to do an exchange and defer the capital tax
Right.
gain, and another may not. So,
Right.
what are the steps, I guess, that real estate investors can take on the front end of an acquisition, of an entity formation, of
Mm-hmm.
a partnership in general, that would lead them to a place where, at the end of it, they could potentially do 1031 exchanges in a way that's split. One says, I'm going to do a
Right.
1031 exchange, other says, I'm going to take the proceeds and run.
Sure. Right.
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 Does it come down to the, operating agreement and the entity formation? If we have an operating agreement and, we call it whatever it is, business entity X, right? And then you have your own entity, and I have my own entity,
Mhm.
and the two entities, I guess, are the members of the other entity, of the entity X, right? And
Right.
maybe I'm complicating this a little bit more than it needs to be, right? Um, is that a way to separate it to where we could do a 1031 exchange later on?
Right. So typically where we see the flexibility to each go your own separate ways is when ownership is tenants in common. So
Mm-hmm.
whether that is two individuals as
Mm-hmm.
tenants in common together, or what we've also seen is two disregarded entities. So perhaps a single member LLC, one of which is yours and you're the sole member, and then the other portion is owned by another single member LLC, of which your business partner is the sole member. And
Mm-hmm.
each of those are disregarded entities for federal tax purposes. So they flow through to each of you
Yeah.
individually. And those two LLCs own the property together as tenants in common and report their respective interests on, your individual tax returns. We've seen that type of scenario, and that way it gives you the flexibility at the time of sale to each go your own separate ways, right?
Mm-hmm.
So that structure has been done, but we realize, obviously, we've had people say to us, well, how the heck do you do that with, rent checks and things like that? Do they have to make it payable to two LLCs? They're like, I'm just telling you what, for 1031 purposes, what could be done, the logistics of actually managing the property and that sort of thing. That's where you need to bring in those other advisors and those real estate professionals that know better.
Well, that's what we do. I mean, our core focus is property management, and we currently manage roughly 2,600, properties across 4 distinct markets: Tulsa, Oklahoma City, Northwest Arkansas, and Wichita, Kansas. I can tell you, I consider Appfolio the Rolls-Royce of property management software as a service. It's a wonderful PMS, property management software. And we can, in fact, deposit 50% of the rent income to one bank account and 50% to another. And we can push and allocate the ownership within our system to, make those deposits in a very seamless way. So even if there are ownership is, divvied up into quarters, and each bank account would receive the proceeds from that month. So it's pretty simple. That's interesting, though, that, if you are looking to get into business with someone else and you're looking to grow and scale, but you may potentially in the future want to do a 1031 exchange, definitely consider doing it in a way that sets you up to do a 1031 exchange and have, two entities that are partners on a third entity, I guess, right? And that third entity could own the property. And
no, it would have to be,
or it would be 50-50.
It would still have to be just the 50 in order to keep that flexibility with taking your undivided interest. Yes, you would want to make sure that those are the owners and not just another part of, a multi-layer LLC.
Yeah.
And, make sure that you're not acting as a partnership. You truly are owning the properties as tenants in common.
Yeah. Beautiful. Very interesting. Could you walk us through, I guess, like, what are the, and I don't know if you would even know this, but 2 questions. One is, what are the general, like, ballpark costs of going through an exchange? Does it matter how large the exchange is? Does it, what changes the price of the exchange? And the second question is, like, how do I know that an exchange actually makes sense to me as an investor?
Sure. So we'll tackle the first question with the fee. Typically, it is just based on the contract sales price, right? So for our fee, I'll give you a good example. It's a tiered schedule. So if you are selling for $1 million or less, it's a flat fee of just $1,250, and that includes the sale of one followed by the purchase of one. If you were to sell a second property or buy a second property in that same exchange, it would simply be a $300 additional property fee. And that gets paid right at closing. It goes right on the settlement statement, and we, get a check for our fee. You don't have to pay it ahead of time or, use your own funds out of pocket. So it just goes up incrementally depending on that sale price. So pretty nominal generally compared to what the potential tax consequences can be, right? And what was the second part of the question?
The second was, how do I know that an exchange actually makes sense to me as an investor? I own a duplex. I'm, curious about the exchange process and how it can benefit me from a tax perspective.
Sure.
How do I know it makes sense?
Sure. Yes. So, for the most part, the sale price of the property isn't necessarily going, we're not going to say, oh gosh, well, you're just not selling for enough. That actually has nothing to do with how much potential taxes you may have. So what's going to be a factor and what you would want to look at is how much did you originally buy the property for? And how much gain do you have? So is there a difference between what you originally bought it for and now what you're selling it for? And how long have you owned it? Is depreciation, is that going to factor into how much taxes you may have? We have had the scenario where someone bought a property and they actually bought it many, many years ago, and they are not selling it for any more than they bought it for 20 years ago. Wow. However, they have 20 years of depreciation that is going to be due when they sell. So even though they're selling it for the exact same price they bought it for 20 years ago, they still have a big tax hit because of depreciation recapture, which is a 25% tax. So, you know, there's really no, you know, one size fits all. It doesn't make sense to do the exchange. It is based on your case-by-case basis and what you originally bought it for and what kind of tax consequences you have based on, you know, your particular tax situation.
Yeah. Wow. So depreciation recapture is then what, calculated back into your what, taxes essentially?
Right. So if you took depreciation, right, on, you know, typically when you own an investment property, you're going to take depreciation on a yearly basis. So whatever the total amount of depreciation is that you took over the time that you've owned this property, they're going to say, okay, you took, you know, whatever it is, 75,000 in depreciation. You now owe us 25% of that back when you sell it.
Yeah, because that depreciation was used to wash away your tax liability in the years that you've owned the piece of real estate. You know, in Oklahoma, there is you're allowed to take accelerated depreciation. So for those investors out there in Oklahoma or in any other market that allows accelerated depreciation, you know, consider that when you are, I guess, doing your cost segregation, or your CPA is doing a cost seg. And then, you know, taking that to help alleviate whatever tax liability you may have at the end of the year. Consider that if you want to do an exchange.
Right.
Yeah. Right. Interesting. Or even sell the property, because if you were to sell the property and not do an exchange and you had so much depreciation, that incident would be even more severe.
Right. Oh yeah, depreciation is one of those things that a lot of people don't factor in or think about, right? They took it while they owned the property and it was a great tax benefit on a yearly basis, but then they go to sell and go, oh my goodness, I forgot about that. You know, it's certainly something to consider, which is why we always say, you know, just double check with your accountant to get your full picture. What tax liability am I going to have if I were to outright sell this?
Yeah. And then they can reach out to you to, you know, better understand how they can avoid any tax incidents if they were to do an exchange, combined with the advice that they've received from their CPA on selling outright. Is that true?
Yeah, we'd be happy to walk through a scenario with them if they, you know, say, okay, well, this is what I'm selling. This is how long I've owned it. This is what my accountant is saying my tax liability is, you know, and my plan is to buy X, you know, does this make sense? Because there are times where, you know, maybe they're selling for a really significant amount. You know, I had somebody tell me years ago they were buying, or rather they were selling their property for 1.3 million, but they only wanted to buy one property for 300,000. And I said, whoa. Hold up. That is a huge difference. And does it still make sense? for you to do the 1031 exchange, because don't forget, right? If IRS is looking at that transaction, they're going, okay, 1.3 million minus whatever your closing costs are. That's what you need to buy for to maximize your tax savings. They weren't even getting close. So
Right.
does it still make sense? The last thing we want you to do is pay us a fee to not save you any taxes, right? So in those scenarios, you know, even though, yes, we tell people all the time to talk to their tax advisor, we really jump up and down when that kind of scenario presents itself, because too severe of a trade down may not make sense. And we certainly want you to benefit from the 1031.
Yeah, that's very interesting. I guess another question that I would have is for someone who is looking to sell a property, and they're looking to buy, they're selling a long-term real estate rental, a long-term investment rental, and they want to buy a short-term rental that's fully furnished and, you know, ready to go and operating, right? Is that something that, you know, you could do on a 1031 exchange, and include in the purchase price? I guess you would break it up into real assets, which is the real estate, and then personal property, which is, you know, the furnishing and everything else that's being bought. And is that allowed?
So for the 1031, the real property value would be allowed, but any personal property would be excluded specifically for 1031 purposes, right? Back in 2017, the Tax Cuts and Jobs Act got rid of the ability to do a 1031 exchange on personal property. So that was replaced with what you were talking about earlier, which was the immediate expensing. So when you're doing a 1031 exchange, it will specifically exclude any personal property from the transaction.
Yeah. Very interesting. And for those of us that are, you know, buying a house, for example, as a primary residence, and then turning it into a rental, and then moving into our next primary, right?
Sure.
Those that we've moved out of, and then we've, you know, let them season as a real estate investment rental property for a year, for example, 6 months, whatnot, that's allowed, right? I could sell this property that I've lived in the past, and it was my primary, and do a 1031 exchange. Are there any rules? Is there a seasoning period that needs to occur? What's the law there?
Yeah, so we see that a lot, actually, where people will convert their primary residence to a rental and kind of hang tough for a while, rent it out. And, you know, I mean, there's no set amount of time, not a bad year to get a tax return or two under your belt, right, with that. But in that scenario, that taxpayer might be able to kind of have their cake and eat it too, because they still qualify technically in that scenario that you just laid out for the primary residence exclusion. And they could 1031 as well. So let's just say they're an individual, right? And they have lived there for 2 of the last 5 years. And then at the time of the sale, it was that rental property, and it's been that for the last year and change. So what they could do is, at the time of the sale, take advantage of that primary residence exclusion, so the $250,000. So they walk away from closing with $250,000, and anything above that would go into the 1031 exchange, and they would 1031 the remaining value. So kind of a great scenario in that case, for people to kind of plan ahead and think about, you know, well, maybe I should hang on to this primary residence.
Right. Yeah.
That's how I get into, you know, investing in real estate. We've seen that happen over and over.
Very interesting. I want to be conscious of time. We kind of delved into just a whole bunch of like spin-off questions and a conversation not necessarily related to the questions that I prepared, but we covered a lot of good stuff.
Okay.
I do have, you know, a couple more questions, if it's okay. And one of them is, you know, there seems to be sometimes this, you know, notion of exchanges are enabling people to make silly investments because of the pressure, right? That, you know, people may experience, and they're so hungry to defer the capital gains tax implication or incident, and it may cause someone to make a foolish mistake to go buy some piece of like kind asset to exchange into. I'm sure you've seen this in the 2 decades that you've been doing it. What are some strategies for identifying suitable replacement properties in tight real estate markets? And how do you advise your clients to just end up taking the proceeds, paying the capital gains taxes, instead of making some mistake that they may regret later in life?
Right. Sure. So honestly, the best advice that we give our clients is take advantage of the time that you have before that 45-day time clock starts ticking. There is nothing that says you can't sign an agreement for the property you want to buy before you've even listed your current property. The dates that are on the agreements of sale do not matter. It's settlement dates that matter. So you could have it set up so that your property you currently own goes to closing on a Tuesday, and the one that you are buying is set up to close on that Wednesday, and you're done your 1031 exchange in a matter of 2 days.
Wow.
And because the real estate market is what it is and has been, those properties that are listed for sale, inventory's tight. So you kind of need to get it locked down so you can feel okay about that acquisition and know I'm not doing this just to wrap up a 1031 and this is a terrible investment. And there are people that will get to the end of their 45 days and they just simply haven't found what they would like to acquire. And they just let their 1031 fail, essentially. And, after the 45-day window has expired, we send their funds back to them, plus whatever interest it's earned, and then they report the sale as a taxable sale and pay the taxes, right? So, obviously, they try to avoid it, and taking advantage of that time before the 45-day window is really the best way to kind of get ahead of that.
Yeah, wonderful. That's great advice. Love that. So identify your property before you even get your relinquished property under contract, and lock it up, and just make sure that it's closing after the relinquished property, right? You can't close before, because you haven't sold and relinquished the property, and funds haven't moved around, and settlement, like you said, is what matters. So your relinquished property has to have settlement dates that are prior to the acquisition of the new one.
It is possible to do it in reverse, just as an FYI. It is possible. It's called the reverse exchange. It is a little more complicated and a little more costly, but if you were backed into a corner and had to buy and close on the purchase before the sale, that is a transaction that could be done.
Very interesting, and we probably need to record a whole new podcast.
That's a whole separate, reverse and improvement exchanges are a whole separate podcast.
Yeah, I mean, I guess that sounds very complicated, because you still have to shell out the money for the closing, correct. And then you would receive it, I guess, almost as like a reimbursement, and then there's probably some paperwork involved with your tax filing. Your CPA would have to.
I mean, the paperwork would still just be the normal 1031, but there's a lot more paperwork on our side that has to be done to make that reverse exchange work. So which is an option.
Awesome. Yeah. Wonderful. Well, last final question. Sure. I did a little bit of research about you, 1031 Corp, and before our call today, finally inspired by thought leaders like Adam Grant, which I saw that you follow on LinkedIn. He's an organizational psychologist that I really truly respect and also follow. How do you incorporate these like innovative ideas and general organizational psychology call it philosophies and frameworks into your work at 1031 Corp?
I mean, I obviously started doing this a lot of years ago, and I have been with 1031 Corp. I started as everybody else does in this company, right? I started as an exchange coordinator, facilitating the day-to-day and talking with the clients, and I have morphed into a lot of different jobs over the years, right? But I always, no matter what I am doing for our team, I am always trying to think of ways that how can I make this easier for them and easier for the client? What processes, technology included in that can we make better and make it work for us so that this process seems seamless for everyone involved? Because there's a lot of rules, right? There's a lot that goes into a 1031. The fact that it's part of IRS regulations, right? That's scary to people. That's scary for someone to have to try to figure out and follow. And there's a lot of rules to explain. We try to really keep it as simple as possible for everybody, and explain things in a way that is easy to understand, right? We do this every day, but it's kind of hard for someone who doesn't do this every day to keep it all straight and figure out, okay, what's next? What do I have to do now? What are all the rules that I have to follow? I know you told me this. Tell me the other 17 rules that I need to, right? So there's a lot that goes into all of these transactions, and we have to think about things from their perspective and answer questions based on what is understandable to nearly everybody, right? And so we've tried to kind of keep our philosophy true to how do we make it simple? How do we make it understandable? When I explain the identification rules and, the same taxpayer requirement and what we can do when there's a sticky situation like a multi-member LLC and not everybody wants to 1031. Right? So we've tried over the years to keep that as easy as possible for everyone, and an exceptional experience because we made it simple and easy to understand, and really keep that 1031 attainable for even the most green investor, and really help them understand the power and the possibilities of what 1031 could do for them with their investment objectives.
Yeah, wonderful. Super interesting, very truly inspiring. Loving all this information. Really thank you for your time, and I really cannot thank you enough, because I know our audience is going to really benefit from this kind of content, and I know that I'm benefiting from this because I'm considering doing a 1031 exchange. I have planned that after today. I'm going to connect you after this call right now. I'm going to connect the two of you and see if you can work together, because he is also looking into exchanging a property. And I hope that we have the opportunity to work together again in the future.
That sounds great. Thank you so much for having me.
Yeah, thank you so much. Marissa LoCascio, 1031 Corp. If you are looking for a 1031 exchange qualified intermediary, reach out to Marissa. Marissa, what's the best way to reach out to you? Email?
You can hop onto our website, which is simply 1031corp.com, or our 800 number, 800-828-1031.
Beautiful. We'll make sure that it's in the comments below. Check it out if you're looking to exchange a property. Thanks, Marissa. See ya.
Thank you.
Thanks for listening to the Same Day Podcast. Tune in to a new show each week and be sure to subscribe to get future episodes.